$1.2 trillion. That's what buyers are paying right now for a piece of Anthropic, the company behind the Claude AI models. At that price, it would be one of the most valuable companies on Earth. And you can't buy a single share. Not through your brokerage. Not for any amount of money. But that's not the strange part. Anthropic doesn't just ignore the market trading its stock. It's trying to shut it down. In May, the company named 8 platforms selling access to its shares and called every one of those trades void. Worthless, never recorded on its books. Some sellers, it warned, might be committing outright fraud. So how does a stock nobody can legally buy end up worth more than $1 trillion? I'm Andrew. This is Signal Tomorrow, where we take the biggest stories in AI and dig out the part everyone's too busy hyping to bother explaining. Like how a private company earns $1 trillion price tag with no stock you can touch. If that's your kind of thing, subscribing helps. Now, how we got here. Start with what's real. Anthropic makes Claude, the AI assistant a lot of programmers now trust to help write their code. In May, it raised $65 billion in a round that valued the company at $965 billion. That's the official number, set by the investors who actually wrote the checks. Real money. Real board seats. Hold on to that figure, because the market has a very different one. Where does a valuation like that even come from? Mostly one thing. Revenue. At the end of last year, Anthropic was on track to make about $9 billion a year. By March, that number had jumped to $30 billion. More than triple in 3 months. Most of it from businesses paying Claude to write their software. That's the kind of growth that makes investors stop asking normal questions about price. That $1 trillion figure everyone keeps quoting? It doesn't come from Anthropic at all. It comes from a resale market, a place where people trade tiny slivers of stock that employees and early backers are itching to cash out. On one platform, called Hive, Anthropic shares jumped about 211% in 3 months. But a resale price and a company's real worth are two very different things. Think about what you're actually buying there. A minority stake. No board seat. No vote. No promise you'll ever be allowed to sell it again. So when someone pays $676 a share, pricing the whole company near $1.1 trillion, that's not really a valuation. It's what one buyer will pay for something he might be stuck holding for years. Scarcity does strange things to a price. Because employees rarely get a window to sell, demand crushes supply. And into that gap steps a whole industry. Its main tool is the special purpose vehicle. An SPV. Basically a shell company, usually an LLC, that pools a lot of investors' money to buy one stake. On the startup's books, all those people show up as a single name. That's the trick that lets hundreds of outsiders in while the company stays private. This is where it gets ugly. An SPV can hold the shares directly, or it can hold a stake in another SPV, which holds a stake in a third. Layers on layers. And every layer takes its cut, around 2% a year, 20% of the profits, plus a fee just to get in. Forbes ran the numbers on one deal. A $2 million stake grows to $10 million, and nearly $5 million of it goes to middlemen. Before taxes. And honestly, the people running these deals often aren't regulated at all. One venture investor put it plainly, half the people in this ecosystem, maybe more, aren't licensed brokers. An Anduril co-founder was blunter. He asked how many investors think they own SpaceX when they're really funding, in his words, their ex-roommate's boyfriend's coke habit. Crude, but the market keeps proving him right. None of this is hypothetical. A firm called Linkto moved more than $500 million before collapsing into bankruptcy, amid claims it had hidden markups of 150% or more. In January, 3 New York brokers pleaded guilty after raising $185 million from more than 1,000 investors. All on hidden markups. So when Anthropic says these deals might be worth nothing, it isn't exaggerating. There's a crypto version of all this, and it's almost too perfect. On the Solana blockchain, someone sold tokens called pre-stocks that supposedly tracked these private shares. When Anthropic and OpenAI warned the trades were invalid, the tokens cratered, down 34% and 39% in a single week. The kicker? A few were backed by as little as $333,000, against implied valuations above 1.3 trillion. So is there any legitimate way in? Two, sort of. First, you qualify as an accredited investor, a net worth over $1 million, not counting your home, or income above $200,000 a year. That opens marketplaces like Forge and Hive. Second, you buy a fund that holds these stakes for you, like the ARK Venture Fund. The catch? Those funds can trade for more than the assets inside them are actually worth. Step back for a second, because this is the strange part. The companies whose value everyone's chasing don't want this market to exist. Anthropic named those 8 platforms and voided the trades. OpenAI sent the same kind of warning. They are, quite deliberately, slamming the door on people trying to hand them money. Which raises an obvious question. Why would a company turn down $1 trillion spotlight? Here's our read. Staying private isn't a delay. It's the whole strategy. These labs can command trillion-dollar prices precisely because the shares are nearly impossible to get. Starve the market, and scarcity sets the price for you. Go public, and 2 things happen at once. The supply of shares opens up, and your finances go on full display. Filing an S-1, the paperwork before an IPO, is a promise, not a plan. The labs had just watched what public markets can do. On June 12th, SpaceX pulled off the biggest IPO in history, $1.77 trillion, up 19% on day one. A triumph. 4 days later, it peaked near $226 a share. Then it fell. Below its debut price within a week, erasing around $600 billion after a $60 billion acquisition spooked investors. OpenAI was watching all of this. The company, worth somewhere between $850 and $880 billion, had been eyeing its own listing. By late June, reports said it might push the whole thing to 2027. Sam Altman reportedly treats anything under $1 trillion as a non-starter. And the company's own line? Some things are just easier as a private company. Read that again. Look, put yourself inside one of these labs for a second. Going public would finally hand ordinary investors the access they've been begging for. But it would also expose numbers these companies would much rather keep quiet. OpenAI reportedly earns around $13 billion a year, while losing about 21. And it would hand the job of setting your value to a crowd that just erased $600 billion from SpaceX in a single week. From the inside, staying locked up looks pretty smart. So, why can't you buy Anthropic stock? Because the very thing that makes it worth $1 trillion is the same thing that keeps you locked out. It stays private, and it stays that way for as long as scarcity pays better than access ever could. As one finance professor put it, it's hard to tell whether these are real valuations or just what investors think they can flip. We'll be watching to see which of these labs blinks first. If this cleared a few things up, a like genuinely helps. Subscribe for more stories like this one, and I'll see you in the next one.